Alright, we're going to go ahead and get started. Some of you may have noticed that, before I get into things here, that the dates have changed for the quizzes. Anybody notice that? Okay. So, pretty much just decided I'm going to do it how I want to do it. I don't really care. So the due dates are all the last day of class again. Again, I would advise you to keep up with us as we go. But if you would prefer to try to learn it all the last week of class, I'm going to let you as adults take care of that.
Still have 2 attempts, correct?
Yes, still have 2 attempts.
And it's still, like, if you get it wrong, it goes to that one question.
Nothing changed other than the dates. Okay. Still firm about once the last moment of class ends, that midnight on May 1st. Please don't come to me at that point and say, "Oh, please, but I forgot, I didn't know," etc. Nothing I can do at that point. With that being said, though, I've talked with several of you about just the overall workload as far as homework and the class in general. And while I don't think it's more than what's standard in college considered the workload, it is more than I wanted it to be. So I'm going to make the Learn Smart, where you're looking at the highlighted sections of the text and doing the questions that way. I'm going to make that considerably shorter, so you have less questions on there for the remaining chapters. And we are going to consolidate the lectures that I do Tuesday, Thursday. So today I will do not only the content, but I will also do the examples today. And then I won't make you guys come on Thursdays. Okay, so I'll give you all of the Thursday time to allot towards taking your quiz each week and any extra homework more than I did last semester. Okay. Anybody have any questions about that or issues with that? Okay. Again, that puts a lot of responsibility on y'all to keep up. I will try my best to remind you as we go, as dates come up, that, hey, you have a couple weeks left, maybe you should think about starting some things, etc. But overall, I'll just try my best to present the material Tuesdays in a manner that is easiest for y'all to learn. And then any other issues that come up, feel free to get with me. If you feel like you need more FaceTime with me than just the one day of class, feel free to set something up. We can work that way. Okay, everybody with me? All right. So moving into for chapter 11, I did send it in as part of one of the emails I sent, but it was kind of buried that I deleted the quiz. So chapter 11 did not have a quiz. I'm sure most of you realize that, but that was purposeful on my part. So just in case you were wondering but didn't ask, I did eliminate that. Okay. So moving into chapter 12, we're going to talk about accounting for partnerships. Now, before I get too far into it, just because you have a partnership does not change a whole lot of the accounting we've talked about to date, right? The main thing that changes with a partnership is the component of the financials dealing with ownership. So owner's equity, obviously if the nature of the ownership of the entity is different than it used to be, then that portion of the financials will also be different than it used to be. Okay, so this is just some of the components of partnerships that the book talks about. Partnerships are considered for taxation purposes. I'm just going to talk about a couple of components here, but for taxation purposes, partnerships are considered pass-through entities, which basically just means they don't have a separate existence for tax purposes apart from their owners, which just means that while the IRS tracks at the partnership level what's going on, the actual taxes are paid once the funds go from the partnership entity to the individual owner. Okay? Apart from that, other things to remember about partnerships: unlimited liability for your fellow partners. So if someone screws something up, you could be taken to court even though you had nothing to do with it and sued on your own because of your partner's liability. So that's a big issue. Limited life means that, well, for partnerships especially, anytime a person leaves or enters a partnership, it's a new partnership. Basically, any changes to the ownership breakdown or makeup of the company cause the old partnership to dissolve and essentially a new one to spring up right then when that happens. That's compared or should be contrasted against corporations, where regardless of who the owner is of a corporation, it continues to live on, right? It doesn't matter how many times you sell the ownership shares of stock in the company, the Google Corp or whatever, Alphabet, whatever they're called now, continues to exist as an entity. Okay. Let's see here. There are some different kinds of partnerships. Limited partnerships, limited liability partnerships, and then you have LLCs, which are not partnerships, but have a lot of the characteristics of partnerships. These are all considered hybrid entities right here. I'm not going to spend a lot of time on them, other than state to state. You could see some or all of these as options for business organizations. Let's see, what do I want to talk about with these? I'm really not going to spend a whole lot of time on them, other than you should just know, hey, for other than some of the legalese associated with these, they operate for our purposes very similar to how a partnership would operate. Okay. All right, so let's talk a little bit about organizing a partnership. Generally, before I say that, I think I've mentioned this before, but there's nothing officially that has to be done to organize a partnership. If two people or more get together and start doing something in order to earn money, they've formed a partnership. Nothing else needs to be done for a legal partnership to exist. Now, most of the time, anyone who's doing this purposefully will also have some type of partnership agreement in place where they have established a lot of the ins and outs of how their partnership is going to work. But in general, and in those places where a partnership agreement doesn't work, you would just revert back to what the default parameters are. But generally what happens is two or more people get together, they decide they want to run a business, do something for profit, and they contribute something. So somebody might say, hey, I've got $10,000 I can contribute. The other person says, hey, I've got this building and land I can contribute worth $10,000. They get together, form a partnership. The value of both of the components that were contributed, $10,000, even though they were different natured assets, this partnership, barring some funky thing in their partnership agreement, these two partners would have equal share in the ownership of the company, because each of their owner equity accounts would have the same amount in it, because they would have had the same initial input. So, is there a reason to what? Yeah, so there is a reason. There's lots of reasons to keep separate equity accounts. But the main reason is you should think back to what equity means. If equity means whatever's left over when you sell off all your assets, get rid of them, and pay off all your liabilities, and then what you're left with is a pile of cash, hopefully, that you give to the owners, how much do you give to each one is ultimately what that would tell you. Okay? In addition to that, some of these partners in the partnership agreement will base how much you get of the income or how much you're liable for expenses on what's in your equity account. So that could be another And if not, what's in it currently, a lot of them will base that on initial. Okay, what did you initially put into the partnership? If I only put 25% of the assets in the initial partnership, I might be stuck with 25% of the income for the life of the partnership, and that would just be based on the partnership agreement. Okay. Any other questions on that? All right. So when we organize a partnership, we of course would do a journal entry. In this example, January 11th, Kayla, Zane, and Hector Perez organized a partnership called Boards. Zane's initial investment is $7,000 cash, $33,000 in boarding facilities, and a note payable for $10,000 on the boarding facilities, whereas Perez's initial investment is $10,000. Okay, so this brings up a couple of things we haven't talked about much, but before I get into that, on the initial, the journal entries that record the initial investments, this is another area where people will often want to, or flip in their mind, whose perspective they're looking at this from. So remember at this point that we're talking from the newly organized partnership's perspective, we're doing these journal entries. Okay? So the new partnership now has in their coffers $7,000 cash from here, $10,000 cash from here. So we debited cash in Zane's journal entry and in Perez's journal entry because they both contributed cash out of their pockets to the partnership. Okay? In addition to that, Zane contributed an asset, a building, boarding facilities, but attached to that building was a liability. This note payable, which is functioning very similar to a mortgage. So, the partnership's perspective, we took not only the boarding facilities, but also the liability attached to them. So we now own that, which is indicated by a credit to this liability account, increasing liabilities, and the credit entry to balance all of that out, or in other words, what is the total amount of debits I contributed to the partnership, netted out, and that will give me my credit side of that. So in other words, Zane is contributing $30,000 worth of assets to the partnership. The fact that that's broken down into these three components doesn't really matter. Overall, $30,000 worth of assets, and so Zane's capital goes up by $30,000, meaning that if we liquidated tomorrow, Zane would be entitled to $30,000 in cash of the theoretically $40,000 that would be left over at the end of the day. Okay? So no matter what the initial investment is, the journal entries to record it for the partnership or whatever entity you're forming are going to be from the entity's perspective, and they will just lay out the nature of everything that was added to the partnership. I don't know if this is obvious or not, but with the fact that we're going to be tracking capital accounts separately, it should make sense that if one or the other of the partners decides they want to take money out of the partnership, that we're going to track that separately. Obviously, if partner A takes $500 out of the partnership, partner B does not want their capital account to go down. So obviously that should stay with partner A's capital account. Then that bullet point number 2 there is basically saying, hey, when you figure net income, you're going to divide that up, or if it's a loss, same thing, you're going to divide that up based on however you're dividing up income and loss for this partnership. Could be 50-50, could be based on initial capital outlay. However the partnership agreement sets it out, this is where you would divvy that up, right? After you've figured out net income or net loss. And then number 3 there, the same process where you are closing withdrawals each year as a temporary account. This is just reminding you that since you have separate owner's equity accounts, you should definitely close each withdrawal to the appropriate withdrawal account. This is what we already talked about, so I'm not going to spend a lot of time on it. Basically, if there's a recipe set out in the partnership agreement for how to divide this stuff up, which there almost always is, use that recipe. Okay. Absent this stuff being set out, it's generally, most states will say that the de facto setup is you divide everything based on the amount of capital that you have invested in the company. All right, so let's look at an example here. We've got a partnership agreement. Zane is to receive 2/3, Perez 1/3 of partnership income and loss. So they're giving us a real easy number, $60,000. This is, again, assuming we've already figured out what the net income is for the year, and it's sitting here in this income summary account. This means we've just recently closed revenue and expense accounts for the year, and we've got this income summary that we want to allocate to the partners. So we just divide that by the ratio that we're given. We're giving 1/3 to Perez, 2/3 to Zane. 1/3 of 60,000 is 20,000. 2/3 is 40,000. And it's so that once you get to that point, really not that complicated, assuming you can read and do basic math. All right, so, well, let's see. Isn't that what we just did? All right. Okay, this time we're instead of the 1/3, 2/3 split up, for this one, they have decided in the partnership agreement that based on their capital accounts, that will be how you allocate this out. Okay, so you look at their individual capital accounts, and this looks very similar to something that you guys have seen recently. So it shouldn't be all that different looking, but the total amount in there between the two of them, or between however many partners you have, is going to be the denominator in the ratios, and then the amount that each one has will be the numerator in that ratio. So 30,000 over 40,000 is 75%. 10,000 over 40,000 is 25%. Once you have that ratio, you would multiply that times whatever's coming in. If it's an income like it is in this situation, multiply it times $60,000 of income. If it's a loss, you wouldn't change the way you're allocating it. It would just be in the nature of the money would be different, right? It would be a negative amount. But that would be how you would show that. Okay, so this journal entry down here, is how it looks for when you have a credit balance in the income summary. So you eliminate the credit balance with the debit to 60,000, and then the rest goes into the capital accounts. If this has been a loss, then it would have been a debit within the income summary. So this part would be a credit. And then instead of crediting our capital accounts, we would debit them, which is showing them going down. Okay? All right, so now we got another scenario here. We're just basically adding more complications. But again, as long as you can follow directions, it's pretty easy to do. So here we start by giving each of these people a salary. So you start with the net income, right? From that, you will give out the salaries, okay? Assuming there's any money left over at that point, you would give each partner 10% of their beginning capital balance. So whatever amount they had whenever they formed the partnership in their capital account, multiply that times 10%, and each of them gets that amount. Then if there's anything left after you've done those steps, then you would divide it out equally. Okay. So right off the top, we got 2436. That's 60 grand. So I didn't see what was in their initial. Oh yeah, it was the 30 and 10. So we had Zane had 30,000 initially in Zane's capital account. Perez 10,000 initially. So step 2 was that 10%. And then step 3, there was $6,000 left over right here. So we just split that up between the two. Okay. All right, so same thing, but now there's only $50,000 worth of income. Okay, so now we're still going to go through steps 1 and 2 here, but now what that does is it forces us to lower the amount that's in the, whoops, I guess it didn't show that there. Lower the amount that's in the capital account. So instead of you seeing this as a positive number going into their capital accounts, that would be subtracted there. And we'll look at some more of these allocation problems. That's most of the examples we're looking at here after the slides. All right, so yeah, we already talked about the fact that essentially anytime a new partner comes in or an old partner leaves, you're going to dissolve the partnership and reform again. A new partner can buy into the partnership by either buying something directly from one of the other partners, so a portion of their partnership interest, or the partners could agree to allow the new partner to come in by having that partner allocate directly to the partnership, add some cash or assets to the partnership, and then they, the rest of the partners would essentially get together and give a little bit each of their equity to the new partner. It's kind of confusing talking about, so I'm just probably spend more time on the slides that actually show it here. But one thing to note is that let's see. If you buy directly from one of the partners, keep in mind that the money paid is directly to that partner, not the partnership, and the equity comes directly from that partner. So it's almost like a side transaction. One thing to note, though, most partnership agreements have a lot of verbiage in there about if you can even have new partners come in. And if you do, what vetting process has to happen to ensure that all the rest of the partners are okay with the new guy or gal coming in. So that is something to to consider. All of these scenarios, we're typically assuming that this is a decision that all of the partnership is getting behind, because most often that is the case. Most often it has to be a unanimous decision to admit a new partner. So we got January 4th, Hector Perez sells one half of his partnership interest to Tyrell Rashid for $18,000. Perez gives up a $13,000 recorded interest in the partnership. Okay, so all that basically means is Perez is on the side selling part of Perez's ownership to Rashid, but this is happening outside of the cash is changing hands outside the partnership. So the only journal entry that the partnership cares about in that transaction is this one. Okay, no cash changes hands. All we're doing is moving some of Perez's equity to Rashid, a new account that we've created for Rashid. Now, we're not saying cash is not changing hands here. Obviously, $18,000 was given to Perez, okay, from Rashid, but that is an individual. That is Perez, the individual, not Perez as a component of partnership, whatever this is called. Assets, very similar. Most of the time we're talking about assets, other than the issue of how you value them, which is typically market value. But other than the issue of how you value them, you're going to treat. Yes, ma'am.
Oh, the 18,000.
Well, you don't see it in the journal entry because that is. Let me go back real quick here. Yep. So actually, all of this money is going straight to Perez. Okay, so that the $18,000 is going straight into Perez. Just think of yourself as Perez, right? You're an individual person. So someone is offered to buy part of your partnership interest from you. So they give you the money. You put it in your pocket. The company gets none of that money because that was your interest in the company that you're selling to someone else. So from the company's perspective, the only thing that changes is part of the company that you used to own, the other person now owns. Okay? So that's why you don't see 18,000 in here because all you see here is from the company's perspective, right? If we were tracking these things from either Perez or Rashid's perspective, you would see the 18,000. But since we're going from the company's perspective, all that we track from the company's perspective is part of the company ownership transferred from one partner to another. Okay, you with me? All right. So in this case, instead of buying an interest that one of the partners already has, Rashid is giving $22,000 to the partnership in exchange for being admitted to the partnership. Okay, so now in the partnership's perspective, cash goes up, and again, similarly, you're adding to Rashid's. Yes, sir. Oh yeah, so we have no idea. I mean, theoretically, I would look at this and say he probably has 22% based on capital numbers. But again, unless I have previous information from previous problems or just knowledge of the scenario, this slide definitely does not tell you that. Okay. I'm sorry? Okay, you good? Yeah. All right, I'm not going to spend a ton of time on bonus to old, bonus to new partners. This basically just means you're not always going to sell equity for the, I don't want to call it book value, but the amount that it's going to show up as in their equity account. So if you are selling an interest in a partnership for more or less than the amount that's going in the new partner's equity account, then there's got to be some way for you to make up that difference. Okay? So if you're selling it for more than what the equity is in the account, that's typically going to be a bonus. It's called a bonus to the partners that were existing before you did this, because they essentially are getting some cash or equity going to them that they otherwise would not be getting. Okay, because essentially you're saying it's just like you're saying, hey, the value of this partnership has appreciated, so we are going to charge you a little bit extra money for it. And since the extra money would not be reported as directly offsetting the equity in terms of debits and credits to the partnership, we would recognize that as a bonus. Just basically divide up the difference between the amount that is there in equity and the cash coming in, and allocate that out to the existing partners. Opposite would be true the other way around, where you're saying, hey, we're going to give you $18,000 equity in the company. All you have to do is give us $15,000. So that would basically be saying, hey, we're giving equity to this new partner, maybe because they have, like your book says, exceptional talents, or for some other reason we decided to do this. Okay. All right, so let's look at a couple of these examples. January 4th, Zain and Perez agreed to accept Rashid as a partner because he invested $42,000 cash in the partnership. He's supposed to receive 25% ownership interest in the new partnership. Any bonus is attributable to the existing partners and is shared equally. Okay, so he's giving $42,000, but he's only getting the equivalent of $30,000 worth of equity. So $12,000 is coming in above and beyond what the dollar value of the equity is going to be to him. So we will divide that equally between these remaining partners. And so that $12,000 extra cash that's coming in is essentially going into Zane and Perez's pockets. Okay? Because right when this happens, they could either or both essentially go in and do a partnership withdrawal and get that $6,000 out in cash and be no worse off than they were before they got this bonus. Okay? What's that? Is that pretty nice?
No, I said I sent it to Karen.
Yeah, yeah. Okay. All right, so now we got the opposite coming in where we say, hey, we're going to give this guy $24,000 worth of equity, and he's only has to give us $18,000 in cash because we're saying he brings some more to the table than just his cash. Okay, so we're going to, again, split evenly between those two partners the decrease in capital that's required for us to essentially give that much to the new partner. So if we're giving him $6,000 worth of capital and we're dividing that equally, then of course $3,000 would go to each partner to lower their partnership equity. Say again? Oh, how much to give them? Oh, 6,000? So, well, if you just look at that journal entry and compare the cash to the amount of capital that he's getting. But if you're looking just in the question stem, how did I get to that? Well, just with the information you had in this box, you wouldn't be able to. They're taking, okay, you got 25% ownership interest. Well, if we add the cash you gave plus the equity that's already there, yeah, so we're basically implying that you have this information from previous slides. For your purposes in this class, all of these numbers are pretty much always going to be right there in the question stem. So, but good question. Okay, so when a partner decides to withdraw from the partnership, that can happen in one of these two different ways. So the partner can sell to someone else, in which case the partnership's obviously a new partnership, but it remains fairly unchanged. Or the partnership can look at the equity account and just distribute out assets of some kind, usually cash, based on the amount of equity that the leaving partner has. So in this case, Perez leaves, and Perez has $38,000 in Perez's capital account, and so as a partnership, we give Perez $38,000, and that's the end of Perez. Okay, as far as we're concerned. So pretty straightforward there. Essentially, we'll just when getting rid of partners, you basically look at it as the equity as a liability to the partnership that we have to pay off in order to get rid of this person's ownership shares. Okay, so let's see here. Date of the withdrawal, Perez, the partners have the following capital balances, 38, 84, 38. The partners share income and loss equally, and Perez is to receive $34,000 cash upon withdrawal from the partnership. Now you might say, well, why? This would just be a case where it's either set out in the partnership agreement or, for whatever reason, Perez is okay doing this deal. Okay. So in that case, Perez is essentially saying, hey, you only have $34,000 to give me. I have $38,000 that you owe me based on my capital account, but I'm willing to to accept that. And so as long as that's accepted, then whatever the difference is between the cash paid out and the amount that was in that individual's capital account would be split up by the other owners. Okay. Date of the withdrawal, Perez, partners have the following capital balances, same amounts there. Partners share income and loss equally, and Perez is to receive $40,000. So again, now we're $2,000 greater than the amount that's in Perez's capital balance. So maybe Perez is an asshole, nobody wants to work with him, and they say, hey, it's worth $1,000 to me to get rid of him. So Zain and Rashid get together and say, hey, let's offer this guy $40,000 to leave, which is a $2,000 bonus, and everybody's happy. Okay, so assuming everyone agrees to that, let's not get into whether or not this is acceptable to the partners, but assuming it's acceptable, then of course we would share according to our share of income and expense. We would share that bonus to the departing partner equally there. I'm actually not going to talk too much about the death of a partner. Obviously, that's a pretty rare occurrence, although it does happen. All right, let's talk quickly about liquidating partnerships. We've walked through this process ever since we started talking about balance sheets, right? Because essentially, when I explain equity, that's what you're doing when you liquidate a business. You're getting rid of. Well, first of all, you're turning all non-cash assets into cash and recording any gain or loss on those assets on your book. Once you have nothing but cash and liabilities, you pay off your liabilities, and then all that's left is cash, hopefully, and equity. And if those two amounts are equal, you just give all of, each owner the amount of equity that they have. You give that much cash to them. You're out of cash. You're out of ownership interests. Everybody's happy. But it rarely works out like that. Okay, so the situation I just explained is this slide, no capital deficiency, which just means when we go to pay out the partners, there is enough cash to cover all liabilities plus each partner's ownership equity amount, and there's nothing left over. Okay, so assuming that is the case, this would be representative of a journal entry at that step one where we're changing non-cash assets to cash. And then, well, assuming that this is all the cash that there is, if we're dividing that equally between these three partners, or I guess in this case that's just the gain on the liquidation here, but it works the same way. We're going to allocate that amount of money between the partners based on their partnership agreement. Let's see. Then we're going to pay off our account payable. That would be step two, assuming that is, let me go back to that slide. So assuming that that's our only liability, we pay off that $20,000, and then whatever is left, in this case, equals the amount that's in each partner's capital account. And so we pay that out, and as of this journal entry, that's basically the end of our existence, okay? At least with respect to our books. But that's just assuming that this was all neat and tidy, which, like I said, does not always happen. In the case of it not being neat and tidy, there could be some deficiency, right? In this case, if you get to the point in time where an individual partner has a negative amount in their equity account at the stage when we're liquidating, the first step for that partner is to get to 0. Okay? Negative in your equity account means you owe the partnership money. It doesn't owe you money, you owe it money. Okay? So once you settle that out, then in this case, there's only 2 partners left once the deficiency is settled, and so the remaining amount of cash is divided between those 2 partners. Okay, so now we've got a deadbeat as the third partner. So Rashid not only has a negative amount in his equity account, but he's decided or told us that he's not able to pay it. Okay? So again, anytime that we're looking at how we're going to allocate gain, loss, revenue, expense, we always look to the partnership agreement, and in this case, we will share equally here. So the fact that Rashid can't pay his deficit means that the weight of that falls to Zain and Perez. Okay. Then, of course, once you take that out of Zain and Perez's capital accounts, the amount that Rashid couldn't pay, then you're left with their new balance. Okay, so that's it for the content portion, and then I've got some example slides I want to go over as well. They're both posted, yeah. All right, first example. I know these are small, but they are posted online if you want to walk through them with me. All right, first example. Angela Moss and Autumn Barber organized a partnership. January 1st, Moss's initial net investment is $75,000, which consisted of $17,500 cash, $82,500 in equipment. Also a note payable reflecting a bank loan for the new business, $25,000. Barber's initial investment is cash of $31,250, and these amounts are agreed upon. Okay, so first entry is going to be Moss's investment, which was that $75,000. $17,500 cash, which would be a debit to cash for that amount, and then a debit to equipment for $82,500. Okay, in addition to that, we've got that note payable talked about right here. So that's going to be, in the company's eyes, a liability that they're picking up. So the company is going to credit notes payable for that amount. Okay, obviously we are out of balance here, debits to credits. The credit balancing entry I need here to balance this out is the amount that's going into Moss's capital account, and we were told that that was $75,000. Okay, and then we got the T-chart of Moss's capital. The other side, we got the simple cash entry, so debit to cash, credit to Barber Capital. All right, next question. Kramer and Knox began a partnership by investing $60,000 and $80,000 respectively. During its first year, the partnership earned $160,000. Prepare calculations showing how the $160,000 income should be allocated to the partners, given these 3 separate plans for sharing income and loss. Assuming that they failed to agree on a method to share the income, that will either be a 50-50 split, or in most cases, we will base it on their capital accounts. Okay, so in this case, we got the 50-50 split. In number 2 here, we're going to base that one on the amount going into their capital accounts. So we're going to have to, again, look at what percentage went into their initial capital account. So $140,000 is the denominator, and then their initial investment is the numerator for the ratio. which, 6 out of 14 is 3/7, so that's 68,571 and 91,429. What's the percentage on those? So about 42% and roughly 58, give or take. Okay, so it really doesn't matter what the numbers are there. You can always plug into that formula, take the numerator and divide it by the denominator for the initial investment. That will give the ratio there, and then you would just multiply that ratio times the income for this period. All right, and then those were the first two methods. Now we're going to complicate it slightly more by throwing in some salary here. So we've got $50,000 salary allowance to Kramer, a $40,000 per year salary allowance to Knox. In addition to that, they're going to get 10% of their initial capital investments. So whatever they put in $60,000 and $80,000 times 10%, so $6,000 and $8,000 respectively for step 2 there, and then 50-50 for anything left after that. Okay, so right off the top, $50,000 salary to Kramer, $40,000 to Knox. That leaves us $70,000 left. Then, again, I said $6,000 and $8,000 to Kramer and Knox respectively based on 10% of their initial capital investment, which leaves $104,000 left over, which we will divide in half and split. Oh, I'm sorry. Let's see. Oh, that's what 56 is what's left over there. Is that right? What is that now? Yeah, 56 is what's left over. Okay, I see how we're doing here. Somebody check that math real quick. Is that right? Okay, yeah. So that should be how? Okay, 70. Yeah, this 104 was just confusing me here, but 70,000 minus 14,000 gets us to 56,000. We just kind of dropped a number out here. So from 160, let me walk through this real quick. 160,000, we took 90,000 out right here, which leaves me 70,000 over here. Okay, that's left over. From that, I took out this 8,000 and this 6,000, which I'm not sure why this 104 is in that spot, but that should be 70,000 there. And from that 70,000, we're going to take out 14, which leaves us with 56, and then we divide that by 2. What's that? Go full. Okay, so yeah, adding all those together down the line would give you the amount that's going to each partner, and obviously that should add up to the full amount. Okay. Kramer and Knox began. Let's see, is that the same stem? $60,000 and $80,000 initial investment. Assume that the partners agreed to share income and loss by granting salary allowances of $50,000 to Kramer, $40,000 to Knox, and 10% of their initial capital investments, and then divide equally. Okay, so very similar. First year income is $98,000. From that, we're going to take away $50,000 and $40,000 because of the salaries. Okay, then with that $6,000 and $8,000, oh, that's what that is. Just those two adding together. That's confusing to put that there, but. All right, so we've got 98,000 minus that gives us 8,000 here. Obviously, 8,000 is not enough to cover 8,000 and 6,000. So instead of allocating between the two partners the remaining gain there, we're going to allocate essentially the remaining loss there. So essentially the three-step process and allocation here, do steps 1 and 2 fully before you think about step 3. Okay? So if we've set out, partners 1 and 2 are going to get these salaries and then these interest allowances. Those items will pay out even if it means we have to subtract from the partner's capital accounts to pay out those amounts. So that's what's happening here. If after step 2, when we pay out these percentages of their initial capital investment, if that gets us to a negative number, then we just will divide that negative number by the partners and take that amount out of each partner's capital account. And again, adding those two together, we should come out to $98,800 being fully distributed. So what happens if we have a net loss here? $16,800 is negative $16,800, I should say, is what we have to work with. But we're still paying out the 50, 40, and the interest allowances to our partners. We're at least calculating that out first. Obviously, there's no money that's necessarily going to go out to these partners if there's no money in the bank account. But in terms of figuring out what the equity effects of this transaction are, we go through step 1 and 2 first. Okay, that allocates out $104,000 there. And then to get us from that $104,000 to the actual total, we're going to have to basically take that out of these two existing partners' capital accounts. So that $120,800 causes each partner's capital account to go down by $60,400. Okay. Which at the end of the day has, if their capital account is increasing by this amount and then decreasing by this amount right after that, then the net effect to their capital account is a net loss in Kramer's capital account of $4,400, a net loss in Knox's capital account of $12,400. So at the end of the day, this loss has been allocated to the two partners via that method. All right, March 1st, 2015, Eckert and Kelly formed this partnership. Eckert contributed $82,500 cash, and Kelly contributed land valued at $60,000 and a building valued at $100,000. The partnership also assumed responsibility for Kelly's $92,500 long-term note payable associated with the land and building. Partners agreed to share income as follows. Eckert is to receive the annual salary allowance of $25,000. Both are to receive the interest allowance of 10% of their beginning year capital investment. Any remaining income or loss shared equally. On October 20th, Eckert withdrew $34,000 cash. Kelly withdrew $20,000 cash. After the adjusting and closing entries are made to the revenue and expense accounts, income summary had a credit balance of $90,000. Okay, lots of information there. But nothing really new or different from what we've already explained. We're just kind of grouping it all into one giant situation here. So the journal entry to record initial partners' capital investments. Eckert had the $82,500 in cash. And then Kelly had land and building minus liability. Okay, so Eckert's cash contribution results in that same amount going into Eckert's capital account. Then on Kelly's side, we've got land coming in, we've got a building coming in, and we've also got a liability coming in. Okay, and the net effect of those transactions all summed together results in Kelly's capital account being raised by 67.5. Building's right here. What are you looking for? Got the building, we've got the land, we've got the note payable. I could be missing something, but what are you looking at, D'Angelo? Okay, so this is from the partnership's perspective. So the partnership is gaining a building. We're not going to show it canceling out in terms of Kelly's. If you were looking at Kelly's books, then yes, that's what you would see. Okay? But from the partnership's perspective, it's basically like it poofed out of thin air. Magically appeared, and in exchange for that, we're giving out some capital. Okay? Okay, so we also have these various capital accounts. Same information still there. Now, we want to show those withdrawals that the question tells us about. Well, it functions just like withdrawals did before, where we're essentially going to have these show up as debits because they, eventually we're going to have them come out of these individual partners' equity accounts. So they're essentially temporary accounts associated with those equity accounts. And the cash from the company, the bank account of the company obviously will be negatively influenced by that because essentially both partners reached into the cash register of this company and pulled out $34,000 and $20,000 respectively. No. Because withdrawals we record, that is what's going to happen to it. What you're thinking, instead of, you're saying instead of cash or instead of withdrawals here?
Instead of cash.
Okay.
Eckert's withdrawal.
Yeah. That will negatively impact Eckert's equity, so you're right in thinking that. But we use the withdrawal account instead of directly doing it to equity just because it's a temporary account and we want to track it year to year. If we didn't care about that, then it actually, instead of removing cash here, we would actually just have this be directly reducing their equity accounts. Okay? Instead, we have it stopping in this middleman account that we will close at the end of the year. So that's when it happens. So this next journal entry will be us closing that account, right? So now, these temporary accounts will be closed to the individual partner capital account. So you can see that if we wanted to skip the owner's withdrawal account, we could have just had Eckert Capital be what we put here, but we have these withdrawal accounts so that we can track it on a year-to-year basis. Okay? So at the end of the year, we were basically eliminating the withdrawal account by crediting it and debiting capital for that same amount. And we will do the same thing with Kelly's withdrawals on the other side. Credit to withdrawals, debit to capital. Okay? All right, so now we're going to allocate this $90,000 worth of income. And how do we do that? We're given one salary allowance, right? Eckert gets the $25,000 salary allowance, Kelly with none. Then we have those interest allowances based on initial capital, which was going to be 10% each. I'm sorry? Are you just walking through it? Yeah. What does that leave us with? So far we've got 40,000, we got 50,000 left. And we're going to divide that equally between the two partners. And total allocations, $58,250 to Eckert, $31,750 to Kelly. Okay? And then finally, closing withdrawals and income summary. Okay, so all we're doing is taking that information that we just gathered, how we're going to allocate this, and debit to income summary, which closes out income summary. Credit to these two owners' capital accounts, increasing their owner's capital by that amount. So then the balances in the partners' capital accounts, which they've been updating as we go up here, are just the net sum totals there. All right, everybody with me? All right, that is all I have for today. Okay, if you have any questions that I haven't answered, please reach out. I'll send an email detailing what I already went over as far as logistics in the class. Otherwise, I'll see y'all next Tuesday.
I got some up this weekend. I almost had to. I walked down the slope. I was not getting on that thing. And I just